So good morning everyone. थोड़ा तो 4 बजे फ्लाइट लेके आया हूँ. Some सब energy है. In which case I'm going to bore you for the next 71 slides. By the end of the session, I would expect this kind of a reaction. At the start, let's have some more cheers, some more acknowledgement of some of the big trends that we see, right? So maybe let me start out with I'm being told that I've got about 2.5 hours to fill it, right? So it's a movie. Unfortunately, it's villain mein hu. So you will have to live with this kind of a poor acting all throughout. But I've chosen a topic which is quite close to my heart, and I just thought I'll lay out some ground rules because this is a topic that is going to disappoint most people out here. Okay, if you're going to think about क्या stock लेना है, क्या sector लेना है, chances are that you are going to get more confused than ever trying to answer that. Okay, so this is not an attempt to even get anywhere close to that, right? Maybe to start out with, let me give a story that I read. Many of you may be aware of this gentleman by name Stephen King. I haven't read any of his books. I can't read horror. Do you know about Stephen King? Yeah. Okay. Great. So, Mr. King was, and I think still is, one of the most prolific writers that is there, that the world has produced in terms of pure number of bestsellers that he's written over so many decades, right? And at the start of his career, I mean, once he became a bit famous, he said he was, kya pata how long I have this lucky streak in me. Let me try and max out, which is what most of us try and do in our careers also. Ki kya pata when this thing will go away, right? And so he had all these manuscripts ready in his table, right? And so he went to his publisher and he said, "Ki let's increase the pace. Let me make more money. You also make more money." And the publisher said, "Nahi boss, in our industry, 1 year, 1 book. We'll put all our marketing machinery behind it. That's about it." Okay. And this guy felt that's not right. Okay. But he also wanted to assess, how much was marketing and how much was that name of Stephen King a contributor to the content that he otherwise writes, right? So he came up with a plan wherein he wrote and published books under the name Richard Bachman, okay? Through the same publisher, he gave it as an anonymous spread. So it's the same genre, the same writer, everything same. And he had about 7 books written from 1977 to 1985, okay, which sank without a trace, okay, everything else remaining the same. And here was Stephen King around the same time. It came out about 10 books, all of them bestsellers, right? Till finally a librarian called out his publisher saying that, I think some of your books are there's a thief in your publishing department. They are trying to fraud you out of this entire practice. And so he contacted Stephen King. And Stephen King then acknowledged that Richard Bachman was Stephen King. Okay. And from the next month onwards, whichever Bachman book came out became a bestseller. Right? Now, the point about this entire story is that most of us, I think, are practitioners or wanting to be part of this profession. And we all know that, hum to data ke bakt hai. We love data. But the reality is that narratives are also important. Okay? The context of the data is very important. And while we may all think of ourselves as, very objective, rational, as this episode show, that even in an otherwise reasonable, meritocratic kind of a marketplace, okay, sometimes the same data can be viewed very, very differently. Okay. So, given that kind of a disclaimer more than anything else, I'm going to talk about 70 odd slides only with data. Okay. And the reason why I came out with this disclaimer is that this data on its own can be construed in n number of ways. Okay. And I don't think there's a right way or a wrong way. Let me be quite clear about it. But looked at it in totality, I think it gives a particular message. It can so happen that it can give a completely different message at a different point of time and with different people, and it's perfectly valid. Okay, so let's move along this journey. It's going to take a reasonable amount of time, so please be patient. So let me lay the context at this point of time. So this is not going to be a presentation where I'm going to speak about the India's decade, the superpower that we are going to become, all of that. Neither is it something that is going to pander to people saying that, everything is lost in India, blah, 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 the world is coming to an end, India is going into tyranny, Raj, etc., etc. If at all, it's going to be an equal offender kind of presentation wherein the optimist, the realist, and even the pessimist are going to get disappointed. There is going to be enough for each of them to try and make out the conclusion. The second thing that I have chosen is that obviously we look at all kinds of data, right? You look at short-term data, you look at medium-term data, and you look at longer-term data. The idea of choosing these, there are about 8 or 9 mega trends or 9 areas that I have tried to cover, is to look only through the prism of multiple decades of data. I have not tried to look at, barring some data points for India for which there isn't too much of data available. Each of these trends are going to span 30, 40, 50, 60, 70 years. Okay. So it has to be kept in context that, a lot of these trends themselves are cyclical. It's not going to play out tomorrow, day after, but these are the longer term trends in the making. The third point is that almost all these slides are open-ended. It will invariably end with a question mark for you to reflect upon and take. If the idea is to kind of open up some other perspective, which possibly you may not have thought about, that's the entire idea, rather than trying to come out with a, an orderly way of progress. In fact, when you look at the slides, it may well appear that what is going on? I mean, we just seem to be meandering around so many different things without any context or without any end conclusion in perspective. I have deliberately kept it that way because I thought that the setting is more about practitioners rather than, end consumers of our products, in which case I would have chosen a very different format. So please mind that this is more a attempt to reflect upon the various trends. Okay. And the idea is we've got reasonable amount of time, and I'm happy to cover each of these mega trends in greater depth should there be a need to understand more in the form of Q&A. The idea is to go on breadth first and then depth in the Q&A session, right? So many of you, obviously, all of us are aware of the term analyst, right? The skeptical analyst, etc. What is a synthesist? Okay. And in some sense, a synthesis and analysis is similar to that of, say, a chemistry lab experiment, right? An analyst keeps going down the dimension curve, going lower and lower and lower, trying to uncover why something is happening, etc., right? A synthesis keeps going higher up the plane to try and take a vantage point view, 30,000 point view of trying to find how something is happening. The idea is not why it is happening, how it is happening, right? So that's the key difference between synthesis and analyst. And there is no right or wrong. I think you need to have a bit of both of them to be successful in our investment professional. But the important point is that synthesis sometimes is like a kaleidoscope, okay? You tilt it a bit, you'll get a completely different pattern. So it is rife with conspiracy theories. You can make n number of khayali pulao with synthesis, and you may think that you have arrived at something, which is why it is important to look at it from multiple dimensions to try and triangulate before coming out with the conclusion in one setting, right? Now, what are we trying to uncover as practitioners of investment? Is there are only two signals that we look at. Okay, we are looking at momentum or trend, and the second signal that we look at is mean reversion. And I'm not talking like a chartist. I mean, I have respect for all kinds of discipline, but I'm not a technical chartist. But be that of a quant, be that of a fundamental practitioner, ultimately we are looking at either sustenance of the same trend continuing, or both ho gaya, it will reverse. That's all that we are in this profession trying to uncover, right? Now, basis my understanding, lower down the curve you go, which is that if you go to a company, then to a business unit, then to a manager, the chance of trend or momentum sustaining and surprising is going to be much, much higher. So, example, and I'm just giving this name because I think, let's take Jeff Bezos, right? If you think that an average entrepreneur has got, say, 5 years of supernormal thing and then it'll fade out, chances are at the lowest common point of a supernormal manager, that trend can last decades and decades. You will get tired if you think that mean reversion is going to come through. What is in momentum can continue to sustain for much longer than mean reversion can come through. But as you go higher up the plane, you go from, say, individual manager to a business unit, to a company, to a conglomerate, to a sector, to a market cap, to an asset class, mean reversion starts gaining more and more acceptance, right? Because one thing cancels out with each other, correlation, etc. starts playing out. And then at a particular point, the law of averages starts dominating. But surprisingly, okay, if you look these in the dimension of time, you actually see a reversion back to trend. What do I mean by that? In the real near term, momentum or trend following works, which is, if you are a quant practitioner, a very short term signal like that of a momentum is a very powerful signal in terms of identifying patterns, right? Yeah, you don't play around with mean reversion as the main pattern to identify and harness in a short term. But if you're looking at, say, the medium term cycle, 2, 3, 4 years, typically it's the mean reversion patterns that start holding up, right? But when you look at decades and multiple decades, okay, especially if you have seen, say, 2 or 3 decades, 2 or 3 business cycles, then if something persists, it's more likely to be that trend. And trends are also cyclical, let's be clear. It's not that a trend will go in this one line. It's going to be cyclical, okay? So the idea of this presentation, at least the subsequent slide, is primarily to look at the mega trends, okay? There are a few slides wherein I will move into the mean reversion as a characteristic also. But because we are talking about decades of data, it's primarily going to focus on the mega trends, right? So let me start out with the first among the 8 mega trends that we see around us. The first is as far as the global consumer is concerned. Yeah. Do you want to dim these slides by any chance? I don't know if people can see it, then great. Because I've chosen a dark background. If that is fine, great. Okay. Now this is the data going back from the 60s. Okay, so we are talking about 60, 70 years of data of the US, wherein we have those data, but this will be true for almost all economic regions, right? What this is basically saying is, out of, say, $100 that a US consumer is spending, how much was going into goods and how much was going into services, right? In the 50s and in the 60s, almost 55% of whatever they used to spend on a monthly basis used to go towards goods. As people become more affluent, it keeps coming down and goes more and more into services. Look at our own spending patterns over the last 20, 30 years. You will see it's very visible, right? We are not going to be stuffing ourselves and buying as many cereal boxes as we used to do in the 20 years back. But we'll be flying out a lot more. We'll be experiencing a lot more newer things, spending a lot more of all our available resources into services as we are getting more and more affluent. And we don't have data for India, or we have sketchy data for India, let me put it that way. This plane will be much higher. I mean, because on an aggregate, whatever we are spending of PFC, a lot is going to get spent on goods, because at the bottom of the pyramid, they really don't have any capital to splurge on services. So everything goes on roti kapda makan, right? It's primarily going to be the sustenance kind of living out there. But as you go higher up the affluence curve, you're going to get more and more spending happening towards services, right? So this is the mega trend that with cycle, with time, with generation, people are going to spend more and more into services than goods. Now, there were two interesting points that happened, this and this, okay? This was the GFC cycle, right? Now, what happened in GFC was there was a downshift in that momentum to services accelerating even more, right? So, if it was going in a particular level, it went down a lot more during GFC time, and people started spending even more on services than they used to spend on goods, okay? So, it accelerated that trend, so to speak, in terms of services. So, that is one key point. The second is what happened in 2020. Any guesses what caused this bump up here? Yeah, COVID. Yes, so obviously during COVID, services were pretty much shut, right? But it is just not a story of services not shut. There was something beyond that. Interest rates is stimulus, right? You had record $1 trillion checks that were given to everyone, and people couldn't spend it on services, or a lot of services were still restricted, and therefore all of that went into goods, right? We are talking about suddenly $1 trillion spending on goods happening in a short span of time, right? So the world is used to a particular factory regime saying that the US consumer is going to grow at this particular pace. Suddenly you're going to cram short of that supply chain and ordering in a lot more amount of goods, right? Now, let's see how bad this entire thing was. So this slide is the same thing as the previous one. The only difference I have put here is that I have plotted the 12-month change in that percentage, okay?
So after GFC, the goods versus service.
Yep, it's an interesting point. So primarily it was also a function of internationalization of the big tech and all that happened around the same time, which are all services dominant, right? So that is one thing. Secondly, there was a significant amount of leverage that was taken up on the consumer side on GFC, which was primarily on goods as well. That also got rolled down, right? So it was both a combination of banks not wanting to fund incremental goods over there, as well as an exceptionalism starting out with big tech starting around at the same time, wherein all of them suddenly opened up in terms of that entire spend. So out here, basically the same slide as the previous one, but I've just plotted the 12-month change just to kind of show you how big that delta was, okay? So if you by and large look at it, every year almost it's a downward sloping, right? Every year almost a 0.5% to 1%, you're trending more and more towards services, right? That's been the norm. Of course, it doesn't happen every year, right? We've seen some kind of developments in the 70s. Then you had again sometime in the 90s, there was something. But look at the spike of this one. It's almost 4 percentage point higher, almost 3 times the maximum that it had been seen in the last 60, 70 years, right? So the extent of the scale, the extent of the stimulus that came through was so large that it reverberated across the world, right? So now what happened, it might interest some of you that obviously there are no factories that could take up these kind of ordering from US. Therefore, pretty much the entire stimulus checks went into China, which was the factory of the world, and it benefited with greater trade surpluses. Might surprise you to know that the shipping lines made almost $1 trillion profit in the period of the last 3 years from COVID. What they haven't seen cumulatively over the last 30, 40 years, they made in those 2-3 years, right? Such was the scale of the spend that went on and accelerated towards goods. And now we are starting to see that coming back, right? We are starting to see that unwind happening over there because of inflation, etc. as well. Now, if you really look at what happened on goods, suddenly if say $1 trillion or $2 trillion worth of goods is being ordered by the mothership, which is the US consumer, goods typically tend to be more commodity heavy, right? Services have very low quotient of commodities. Goods tend to have anywhere between 40, 60, 70% of commodities, or maybe even higher, which meant that suddenly you had a squeeze in for these resources, which otherwise were completely neglected, etc. And so you saw a spike in almost all of these commodities, right? Be that of metals, started out with metals, then to a certain extent energy came through, and then lastly when the Ukraine development happened, even the food prices started spiking up around that same time. Now at this point of time, you had this great hyperbole of regime shift and secular shift happening to commodities, etc. Many strategists believe that, you're going to see a complete shift. Commodities which were neglected for 20, 30, 40 years are going to see a completely different kind of an era wherein the resources are going to be king. And while the jury is still out, let's see what essentially transpired. Okay. This is just one commodity that I picked up, and it's a very useful commodity because it has got multiple downstream applications, which is that of steel. Okay. Now, just steel, without any of its downstream applications, roughly corresponds to about 1% of GDP, right? Of global GDP. I'm not talking about the Indian GDP. So roughly about $1 trillion of spending happens, or that's the revenue pool of the steel mills, which are there, right? And it spiked up close to about under 100, 120 basis points more in a short span of time. And I'm sure many of you may recall US steel prices going through the roof, etc., right? So you had in a very short span of time this entire explosion, because obviously demand never kept, or supply never kept pace. You didn't see any new capacities coming through because everybody knew that this was a temporary phenomenon, which is why even with high prices, you didn't see any new capacities come through, right? And yet you had such a huge amount of spike, which effectively means what? Demand disruption, right? So let's look at the same data points from the lens of a global cycle, okay? I've used 2019 because this was the pre-COVID kind of environment. The better thing might have been to use, say, 2010 to 2019 averages. Maybe that might be better, but any which case, this is a point in time, 2019, right? Crude as a percentage. So when I say crude as a percentage of overall GDP, I'm basically saying the total revenue pool of all the crude at whatever, 60 or 70 dollars multiplied by 100 million barrels roughly. So I'm not getting into the downstream effects of any of these. I'm not getting into petrochemicals, refining. This is the basic ore or the basic output for each of these categories, right? So these three put together, and these are the basic commodities that we all have, right? Accounted for 8% of our GDP. Again, this is all global GDP, right? And in 2022, when the Ukrainian conflict and the prices went up to those levels, that translated to close to about 12%, almost 4 percentage points higher, moving into basic commodities, going into the hands of the producers, right? So this was like a massive transfer of surplus from the consumer to the producer, right? 4 percentage points is massive. I know of so many families, who purely basis on inventory, for example, in steel in India, okay, who made as much money as possibly the last 20 years put together purely on inventory gains, right? That was the amount of money that people were rolling in purely because of the largesse of the US consumer or the US government, which gave out all of those handouts, right? Now, let's look at these same data points in absolute terms, right? World GDP in 2019 was about 87.5 trillion, and in 2022, it was roughly about 95 trillion. I just rounded it off, okay? And the increase in this, just the delta increase from 2019 to 2022, meant that out of this $7.5 trillion, close to about out of the $7.5 trillion, close to about 55% of that incremental delta purely went into these basic commodities. Now, that is an overkill one may think of. So, this is possibly one of the few slides that I have used the mean reversion. Generally, I have not focused on mean reversion, but just to give a sense as to how the bigger trend is likely to emerge, that we are likely to go back into the regime wherein these things are likely to be a lot more cheaper than what they were at the peak of 2022. Are they going to be a whole lot cheaper what it was from 2010 to 2019? We'll find out in some time to come. But the prices of 2022 meant demand destruction left, right and center, which is what we started witnessing, and that's where you've seen that entire inventory destocking cycle still happening even now compared to where it was before, right? So if there was a significant spike, if there was a significant inflation that we saw in goods, let's look at the most basic commodity of all, which is labor, right? That is the most common commodity that we have. And let's see some longer term trends as far as labor is concerned. Let's start out with the fact that the fertility rates have been coming down quite drastically over the course of the last 70 odd years. Okay. There is this metric called the replacement rate, which is where the population sustains, right? That number is close to about 2.1%. India has fallen below 2.1% last year, right? So we've also joined almost all other countries whose replacement rate is, or whose fertility rate is below the replacement rate. But look at China, okay? The green line is China. China's fertility rate is now one of the lowest. In fact, I had done this in work, if I'm not wrong, out of some 185 countries listed in UN, or maybe there are 200, I don't remember. There are only 20 countries now which have a fertility rate lower than that of China, okay? And China, obviously, we've dethroned them as the world's most populous country, but it has tremendous implications, as I'll show you in the times to come, right? So you going through a phase wherein the number of babies being born are lesser and lesser. Now, because I spoke about India being at levels where fertility rate is lower than that of replacement rate, I thought this slide might be interesting for some of you. This is basically the survey. It's called the National Family Health Survey, if I'm not wrong, NFHS. And there is the fifth survey and the third survey. So this is the gap between the fifth and the third survey. It's still a survey. It's not like 100% data, but it's still a survey. Broadly, there are only now 5 states where the fertility rate is greater than the replacement rate. Every other state is now below the replacement rate. What used to be purely a south and a west phenomenon, wherein, you know, the fertility rates had already come off in 2005, 2007, is now spread almost all across India, right? Which has got positive and negative implications, as we all know. But currently, there is basically just Bihar, which is there. And if you, as I'll show you in the next few slides, the pace with which these fall can be quite astonishing, right? And that has got tremendous implications in terms of the future terminal value that we are paying to various consumer franchises, right? See, so yeah, this is from 1990 to 2020, okay? Just look at the pace with which China, which was at 2.5, has come close to about 1.2. And that number is now at 1. The pace with which things have fallen in less than, say, 30 years. Within a generation's time, you're seeing these fertility rates at the scale of China coming off, right? Which has implications for the dependency ratio, okay? Now, look at this dependency ratio which is there, right? Let's start with the absolute shocker for me is South Korea. South Korea in 2020 has got about 20 to 25% of their population who are going to be dependent on their working population, right? That number by 2050, in under 30 years from now, is going to be 70% of their population is going to be dependent on working age, okay? You can understand the implications that are going to come through for those who are going to earn and sustain so many dependents, and in terms of the saving profiles that are going to get unleashed, etc., right? If you look at India over here, is possibly the only one. India is also going to see an increase without a doubt, but it's the only one that's going to go from 10 to about 20%. And then it's going to deteriorate quite fast. So we've got under 30, 40, 50 years, wherein we still have what we all keep touting, the demographic dividend, which is going to wither away beyond the next 30, 40 years. Okay. Which brings me to China, wherein basis projections, and these projections keep getting revised with every passing year. The number of the cuts that I keep seeing are only accelerating. We are likely to see by 2100 our population back to 500 million, which means basically 1 billion people are going to go away from China over the course of the next 60, 70 years. Okay. Now, for a country which has done all the heavy lifting with infra creation, with the hope that you're going to consume, if you're going to have lesser number of consumers, how does that translate into the investment from a longer term basis is something that all of us can postulate about, right? So, this is as far as China is concerned. And so about 20 years ago, we had this great presentation, I forget by whom, wherein we had this benefit called the six-head theory. I don't know how many people may remember it. Basically, at that point of time, any new Chinese born basically had 6 people doting on that particular baby, right? The 2 sets of parents and the 2 sets of grandparents. So 6 people would give all their money and their joy and their wealth pampering that boy invariably, or that girl, but mostly the boy, right? That was courtesy the one-child policy that was in vogue for the last 30, 40, 50 years, right? Now you're going to see the complete reverse of that. Basically, one person has got to feed 6 mouths on top of him, right? It's going to get completely inverted, which is where I'm told, I have no way to verify this, that there are actual dictates which come from the CCP, which say that you have to at least visit your parents once a year, already starting to come through in China, right? And which is where you are also seeing all kinds of, issues with fertility. The reason for fertility is the cost of education is skyrocketing. Again, these are anecdotal data points, which says that the cost of educating a child in China up to his or her 18th year is 5 times the income of the parent at the birth of the child. Okay, that's an insane amount of wealth that needs to get spent on just one education. Nobody knows whether this data is right or wrong. This is basis various surveys, which is where the government has gone completely, in terms of killing of that edtech industry, because people cannot be using not having money to spend as a reason not having babies. So they've been trying to architect this entire move to get people to have more babies. But the reality is that despite abolishing the one-child policy in 2011 or 2012, the fertility rates are only declining. The number of newborns in China last year, if I'm not wrong, were the lowest that they've seen in 100 plus years. Okay, surely in terms of the number of newborns that are being born. But again, this is well known. The pyramid that we keep talking about, of course, it also means that we have got under 30 years to get our act right, post which all of this, whatever I said, will become our liability also soon enough. Okay. Which brings me to the point as to why inflation in the form of wages and services came through. I'm sure many of you who have visited abroad may have seen hotels, airports, taxi unions, etc., proclaiming that, they are short of staff and therefore to excuse their turnaround times, etc., right? And part of the reason in my belief is this entire issue of migration, okay? In 2016, the Orange Ban came, and that pretty much was one of the peaks in terms of the net migration that came into US. Of course, at the same time, Canada saw an entire migration of people moving away from US and going into Canada, right? That was the entire thing. But even before the pandemic, the net migration in US was the lowest that they have ever seen in the last 60 years, okay? Which has meant that, while employment is running full in various quarters, at the real lower end, the blue-collar workers, wherein there was significant amount of migration that was happening, there aren't enough taxi drivers, there aren't enough people who are likely to do that job. Now, the good thing is that this is a problem which can be easily fixed. All it requires is an acknowledgement of the problem. The bad thing is that this is again government and jingoism and all that, right? So depending on how it plays out, we'll get to see whether inflation as far as the services can be corrected or not. Okay. This is as far as Indian migration is concerned and Chinese migration is concerned. Okay. In the 90s, quite astonishing that so many people went out from China to the rest of the world. Okay. India has seen a significantly larger episode of migration, even though now we are seeming to get a lot of headlines in the 2007-9. I think it's more a function of the countries outside accepting rather than, people wanting to go or not. It's more a capacity constraint from that end rather than from our end. So the question really is, if the Western world were to loosen their migration policies, I would think that India and Indians stand to benefit most disproportionately from that kind of a policy regime that can open up. Alternatively, if they are not going to do that, still we are going to benefit. How is that? In the form of, say, service exports. Now, this is a chart which, we've definitely been punching above our weight. Close to about 4.5% of world service exports, India accounts for much, much more than our share of the economic activity. And if you really look at it, okay, both our software exports as well as remittances, both are in some form or the other are exporting of our labor in some way or the other, right? So if you're going to have a shift wherein no migration is going to get allowed, possibly wages are going to go up even higher, right? Which means that the labor arbitrage to India is going to get even more bigger, which means that regardless of whatever happens with ChatGPT, etc., the economic incentive to move to countries like India actually goes up even higher. On the other hand, if they're going to fix that issue, you're going to see a lot more remittances coming in from people who are going out. Okay, so heads I win, tails you lose is one of the few places that you see such kind of a policy outgo. Of course, it can have multiple implications from an investment point of view on the discretionary side, or in terms of money transfer itself. That could be another area that you can look at. Okay, there's this entire talk about reshoring and getting supply chains back to the developed world. The reality is that over the course of the last 30, 40, 50 years, most workers in the developed world have kind of had it easy. Okay, they've stopped working 20, 30, 40% lower than what their generations earlier used to work around, right? Which begs the question whether, if these factories, etc., do go there. Of course, there is automation, there is robots, there is AI, IoT, and all that's going to happen. But then for a lot of assembly level kind of work, can it actually go all the way back into the developed world? Yeah. And with time, snowballing happens, which is where we are starting to see even China starting to lose its competitiveness compared to the rest of the world. This is something that might interest you in the sense that we all know about Chinese prowess in manufacturing, the number of people who are into manufacturing over there. But that has actually peaked and it's on its way down. In 2011, it peaked out in terms of employment in manufacturing is starting to come out. India is actually starting to improve. Of course, COVID saw a blip. The OECD world, of course, is continuing its slide, which seems to be a long-standing slide. Okay. The common association of Indian manufacturing is always that it is more jugaad. There is very little participation in the high-value tech, etc. And by and large, it is true. But we are at least starting to make some improvements over there. So this is high-tech exports as a percentage of manufactured exports, right? Of course, we are importing a lot from China, and that's a whole different thing. But what we are exporting, it's in a sense our competitiveness, because people can buy from anywhere. There is no particular reason to buy only from India. Okay, and we are starting to see that share of high tech going up in India. Of course, China is in a completely different league. They, of course, have started coming down, but it's a significant. So there is this interesting ranking. Of course, it's a survey or a ranking, so you can have your own thoughts about it. called the Economic Complexity Index. This is run by Harvard. Okay, but broadly, if you look at India, okay, and this is from 95 to 2021, from 60th rank, we moved up to about 42 rank. Okay, of course, South Korea is at number 3. But if you think about all the people, from where China plus one, etc., the narrative comes through, Vietnam, Bangladesh, Indonesia, etc., a lot of those countries are actually much, much below us when it comes to the economic complexity. So there are certain things that we are doing right. Of course, Vietnam has got the benefit of a Samsung investing big time over there, right? But outside of that, there isn't anything else that is getting developed over there to kind of absorb the kind of China plus one that can eventually come through. Of course, Mexico is significantly above us, and therefore we need to move up because that is where a lot of other avenues or other places where it's going through. Okay, so that's as far as the labor side is concerned. The fact that on the good side we saw a very sharp spike up, and now a letting off. In fact, in real terms, we are actually seeing negative volume growths in US, in the developed world, and now even in China, we are starting to see that, right? As far as the labor is concerned, the solution seems quite obvious to me, but whether governments will actually move along those lines remains to be seen. So depending on which side of the equation governments take, either you can see a widening of the labor arbitrage, or you can see a greater remittance pools coming back from India could be one way. Now, let's move to the third dimension, that of the energy on the global side. This is a very interesting. Obviously, we all know that, over time, our energy requirements keep going up, right, as a country. But if you look at this line, okay, and this is over from 1965 to 2022. So we're talking again about 60, 70 years. It's quite insane that our per capita for the world is been flatlining at about 4.5 barrels per year, or close to about 6.75 MWH. I don't know what the unit is. Is it million watt hour or something else? I don't know. But this is what it has been flat for almost 60, 65 years, right? Of course, there have been countries in the developed world where it has come off and continues to keep coming off. The one exception, no doubt, is China, which has gone up. But even that is lower than the world average, despite them rising to the second largest economy already, with whatever 30-40% of the world manufacturing happening out of China. Despite that, given the efficiency improvements that we've seen, they're still running lower than the world average. India and Africa are a small blip, and that is where the future growth potential, etc., can come through, right? So a lot of people have this huge hope that, China reopening, India, etc., are going to be the next drivers for energy and petroleum growth, etc., coming through. But at least the reality over the last few years have been otherwise, okay? What I plotted here is the 4-year CAGR. The reason why we plot 4-year or 3-year is primarily for the COVID issue, right? You had 2020, so if you want to obviate that thing, otherwise you're going to see a huge spike and a huge fall, you tend to look at from a lens of 3 and 4-year kind of a CAGR. Firstly, this is for over the last 30 years. The Chinese per capita oil consumption, despite it being whatever, multiple times India's, continued to be at a faster run rate than India's, okay? But from 2016 onwards, it has been on a tailspin down. In fact, and of course, 2022 was also a function that they had closed their economy and they were late open. But even if you look at 2023 data, this number is still negative. So there is now definite worries whether China can actually power the overall economy in terms of growth comes through. India, of course, the quote-unquote superpower in the making, is expected to grow, and of course it will grow. But the pace of degrowth or the amount that China is going to vacate, I doubt whether India can kind of make good that, right? And these are the two great consumers which are fast growing, and that is the seen as it stands today. Okay, this is from India specifically, again 4-year CAGR. Okay, The red line is basically our average over the course of the last 20 odd years, roughly at about 4%. We are currently negative. Of course, this is monthly data. There is going to be some amount of seasonality, etc. But I think over the course of the last, since post-COVID, we've been on a lower than the average run rate. And clearly, there is the entire COVID issue, which has set us back. I guess it goes without saying. But whether we're going to spring and get back to the earlier growth rates, we'll have to wait and watch out for. Okay. The fourth mega trend that I have is that of productivity. Okay. Now, there are basically two axes out here, right? The first axis out here is the number of change in annual working hours per worker. Okay, so more number of hours that a worker is increasing, the better it is. And the x-axis is basically the change in productivity. Now, for any young, developing economy, it is important that we scale up in both these dimensions. We are increasing the number of workers, in terms of the worker hours, and we are also going to increase the productivity with which these workers come through, right? Now, if you look at this chart, this is from 1990 to 2019, so a 30-year kind of chart. Clearly, China, after its WTO entry in the 90s, has made the most out of it. I mean, they've zoomed in both in terms of the number of workers that have gone into the workforce, going into various places, as well as the productivity increases. And these may seem very small numbers, but these are, over 30 years can snowball into huge, and which is what we've seen such a rapid rise in terms of their overall economic output. So if this is primarily of that first decade, 91 to 2001, and clearly you can make out, the difference of China vis-a-vis the rest of the world, right? They're miles ahead of anyone else. They basically captured the areas that were being vacated by the developed world, thanks to the entry post WTO, and also massive increases in productivity. This is from 2001 to 2011. India starts to get its act right, but China continues to grow ahead of India. But the big difference I see is 2011 to 2019, wherein for the first time our productivity levels as well as the number of worker hours has gone up more than China. Okay. Now, if you think about what all is changing in our country, we keep talking about, tax changes, GST, RERA. At the end of the day, the digital stack, okay, all of these are massive productivity boosters, right? You look at even our public goods deliverance, the amount of vaccinations that we could deliver in a reasonable short span of time through the digital kind of a network that we've built up. The last 10 years have been possibly the years wherein the maximum amount of effort in terms of improving the efficiency of the economy has come through. Okay. Now, typically, efficiency is a good word for those who have resources, right? So, if you own capital, let's say you are a truck owner, okay, and as a truck owner, you can do more rides faster, okay, you can employ with lesser cost, you can earn that much more, right? So, if you have the resources, you are making the most of any of these things, right? But if you don't have the resources, let's say that you are an unemployed person who otherwise would have got employed into the truck because it was inefficient, okay, it was inefficiently run. Today, you don't have that chance to get absorbed into the economy, which is where we are starting to see that big divide of that K-shaped economy, wherein we focus so significantly on productivity. At the end of the day, efficiency and productivity, in some sense, hurts growth, right? Growth in the normal sense. But this is what can springboard our growth into the next decades to come. And which is why capital markets love these kind of reforms, right? Firstly, we have the resources, we benefit from this. But more importantly, these are hard to implement. And once you do it, the runway for growth can be for a much longer duration.
In the latest case, the problem was just laying out that it's similar organization getting you.
I don't think the senior population, see, this is a time frame where migration was still on, right? So it wasn't so much of I think the real challenge for US, etc., is going to come through when we look at the next 10 years, possibly, if they don't reverse those migration policies, wherein you're going to see a continuous rise. But yeah, US, for the economy of their size and stature to continue to keep growing on both those axes is quite phenomenal, which is not the case for Europe, as you would see in most of the charts. Europe is pretty much a sick patient on steroids for a long period of time, right? US also has got steroids, as I'll show you in the charts to come. But at least once they've taken the steroid, they'll try and jump around a lot more. So productivity is the lump all kind of a thing, which can't be explained by anything else. You drop it into productivity. So it's not a great measure of anything in that sense. So it's a residual if you look from a regression kind of a thing, right? So logically, it shouldn't matter as to how it is, because what you can't explain through capital, labor, and technology, you tend to measure it in terms of productivity. So yes. Yeah.
So the shift in probably the tech shift and so on may have account.
Possible. But actually, when you look at productivity and US, of course, they have these detailed studies that have come through. The sector, if I recall my thing correctly, the sector which has seen actually the biggest fall in productivity has been tech, which is very surprising, right? And it's also a rate of change, right? In 90s to 2000, the rate of change in tech was of a different level, that they got the benefit of productivity of that scale. And now you're seeing a marginal rate of that benefit that is coming through. So if you measure only the productivity change of technology, that's what it's at least stacking.
Manufacturing from US to China happening, right? Yeah, I don't know. I thought that.
Yes, it's also a function that more and more is going to services, which is generally more productive. If you're measuring it from, say, GDP per person, the value add in services typically tends to be a lot higher than the value add that you do in goods, because a lot of the goods value add, if you look at it, commodities are pretty much what you import from outside. It's not necessarily domestically value added. What you're going to value add is going to be a small sliver after energy and all of that, right? Whereas in services, you can actually capture a lot more value add. So yeah, that's also another nuance that you can think about. There's this great database in India. So firstly, in India, I think, data is very hard to come by. I think most of us would have recognized it. It's more touch and feel. It's like the blind men looking at the elephant from different ways, right? And macroeconomics, etc., India suffers even more. But there is this great database that's come out, which is called the CLEMS database, KLEMS. It's come out by RBI, which actually chronicles an astonishing amount of data from the 1980s till 2020 across various sectors, okay? And so for those of you who actually want to look at it, it can be a lot for many of them who want to do PhD. It can be a source of many PhD theses that can come through. But for those of us who are more into the application of data and longer term trends, I think it's got some interesting perspective. I've just taken two important perspectives which I thought caught my eye. First is, we all know the basic problem in India, which is that agriculture, which is a small part of our economy from an economic output point of view, accounts for maximum amount of employment, shadow employment, etc. And over a period of time, that has to get absorbed into manufacturing or other areas, finally into services. That's the natural progression of most economies. We've kind of moved from agriculture to services, a lot more services, because of various factors. Manufacturing hasn't really grown. That's at least the narrative out there, right? A big chunk of people who have moved out. So this is basically, in the 80s, 70% of employment was in agriculture. That's come down to 43%. It's still it's the largest sector, obviously, but it's a meaningful shift, right? And the sector where the maximum number of people have gone into is, not surprisingly, construction, right? Construction is where reasonably low-end, low-skilled work happens. But unfortunately, if you look at the labor productivity ratio of construction to farming, it's been dipping quite significantly. The value add of construction compared to the value add of farming itself is a very low value add. Construction is supposedly a higher value add, But the difference between the two value adds has been keeping on declining, right? Which brings me to this point. Okay, this is truly an astonishing data, which I have no way to validate, but this is what the data shows, right? Look at this data, construction. Okay, this is basically real wages from 1980 to 2020, right? Over a period of 40 years, the real wage growth is negative in a sector like construction. Effectively, if somebody was getting a real wage of 100 rupees in 1980, he or she is getting 91 rupees by 2018. Okay, it is not kept in form of inflation, and that's because the value add and the productivity growth in construction has been so abysmal, right, that it has not been able to justify any amount of growth. The sector which has seen the maximum growth, surprisingly, is manufacturing. Okay, that's where there has been a significant growth in terms of wages per worker, going through in terms of real wages per worker. Services, of course, have done very well. Not surprisingly, an area which has done exceedingly well is non-market services, which is basically administration, mostly public administration, government services, which is where you see this huge amount of applicants to a job compared to the final selection in various government offices, right? But this is actually, if I were to flag, this is possibly one of the biggest challenges that we have in our country, which is how are we going to move people away from agriculture into what else, right? Construction is not the answer, as we are starting to find out. And possibly, this is what it said, right? Sure.
Most of that negative, that from 1819,
Yeah.
there's 90 and 4 hours.
Yeah, but badly so, right? And if you look at, say, agriculture during that same time frame, you'll see that it's generally much better. And agriculture itself is not a very lucrative profession. I mean, I am not being offensive, hopefully, to any of them. I mean, there is a lot of rich farmers, etc. But the reality is that it doesn't pay that well for the scale of output that it brings and for the scale of employment that it has, right? So, and that is where all the shadow employment or disguised employment is, right? So this is basically the value add per person, right? Just look at it, and as you rightly pointed out, the bulk of the decline came in the 80s. Are shocking, right? Almost a half the output from almost 190,000 to close to about 110,000 happened in that short period of time. And over a period of the next 30 years, we just reached about even keel over there. And this, to my mind, is a big challenge. And if you ask me, I think assembly level work that we are trying to do through all of these electronic manufacturing, PLI, etc., is possibly one of the solutions to get out of this entire thing, right? I mean, it's quite ambitious to believe that, we are going to design everything. It's great if we get up there, but if we are going to absorb labor, it has to be at the lower end, assembly level workshops, auto ancillaries, electronics and all that, which is where I guess that entire PLI initiatives kind of get slaughtered at.
The stable includes both the private and the public.
Which comes to the next slide. And this is, I think, a fascinating chart. I mean, this 8, 10, 30, this is households. Households is basically informal sector, unorganized sector, right? Basically everything that doesn't pass muster or there are no records kept invariably. Right? This one is the public sector, okay, 11 going all the way to 28. This is in lakh crores or trillion rupees, right? And this is the total wage bill of India. This is what the total wage bill comes through, the labor share of our entire thing. So it totals up into what, 80 lakh crores or roundabouts, right? The rest, of course, is the capital share, etc., right? So the fascinating thing is two things, right? In FY12, our private sector, and this one is the private sector, this is PSUs, and this is unorganized, okay? In FY12, our private sector total wages at 8 lakh crores used to be the same as the entire unorganized wages, okay? This number has grown to 19 lakh crores, whereas this number has moved to 30 lakh crores. Okay. When we keep saying about unorganized to organized, etc. happening, this is possibly one of the best ways in which we can kind of visualize that huge shift happening from the unorganized to organized, right? More importantly, for the first time, you are now seeing private sector wages actually go above that of the public service wages in aggregate. Again, public service in terms of workforce might be, say, 1 or 2%. I don't know the exact numbers. This is a lot many. It still means that they're paid insanely well. Good for them. But if this trend were to persist, and this just in our last 10 years, we are not talking of, 20, 30, 40 years. We're just talking about what has happened right in front of our eyes. If you're going to think about what's going to happen in the next 10 years, think about the changes that can bring through in terms of the formalization of the economy. It's got huge implications in terms of taxation, the buoyancy of taxes, which have been struggling and stagnating for a long period of time. It's got huge implications on even financializations of these savings, because a lot of those things, typically once they are any which case taxable, etc., they come into the financial markets a lot more. We are all part of that same ecosystem, can continue to see the buoyancy that we are seeing. It's got implications on the real estate side, where earlier everything used to be happening more and more in the black. Now, increasingly, a lot more is going to be formalized and going to happen in the white, so to speak. Multiple streams that this thought can go through. Of course, it's just 1 decade of data. Like I said, Indian data, I unfortunately don't have very long. But what is there? This is, I think, one of the most interesting trends that I have seen. Okay. Coming to the 5th trend, that of debt. Of course, the world has been on steroids, right? Almost every other country's debt has gone much, much more than that of their overall GDP. In India, by and large, been roughly same, so it's not too much of a difference. So therefore, it's been a lot more measured. This is again on the staggering data point, right? Since this is from the GFC start, Q1 of 2008, India is possibly the only large economy which has actually seen a reduction in its overall debt to GDP when looked at from household, corporate, government, and total put together. It's quite a staggering stat that the course of the last 15 years, while the whole world has been on steroids and pump priming through various means, India has actually done a lot of hard work in terms of productivity enhancements. We have had our own share of problems, which I'll come through, which is why leverage and credit never went up. But without credit, we have achieved whatever we have over the course of the last 15 years, right? I think that again is something that capital markets loves, that without the leverage factor, you're giving those kind of growths. Okay. We all know this, that we went through the twin balance sheet problem in the whole of last decade. That's now largely cleaned up, right? If you think of it, before COVID, after the IL&FS issue, etc., the single most dominant discussion in boardrooms is how not to be an NPA, right? Because of, you had that entire NCLT, IBC, a whole bunch of things that people didn't want to be part of that. That has changed quite dramatically, as I'll show in the subsequent slides. This is again a rise of the phoenix effectively. It's got its own implications, of course. I've got my own mean reversion trade out here, but nevertheless, this is again 30-year, 35-year data, right? This is just the profit pool of the scheduled commercial banking system as a percentage of the overall GDP. That's now running at 1%. That's the highest it has ever run in the last roughly about 30-odd years, okay? It's been a staggering revival, to say the least, in the last 2, 3, 4 years. Now, the question, of course, is that is it a mean reversion trade, or is it going to be a continuance of the trend? My own personal view is that in a socialist country like India, this is more a mean reversion trade than a continuance of the trend. But we can have that debate maybe in the Q&A if people want to understand that more. But the more important point is that the capability and the capacity to lend is a lot higher now than it was at any point in the last 10 years. Okay, so you've got both the balance sheets of the corporates in good shape. You've got the balance sheets and the capability and capacity to lend in good shape as far as the banking system is concerned. And all it requires is animal spirits to be kindled for this cycle to get rejuvenated. Okay. On the brilliant data point, of course, because it's Indian data, there are only 20 years. So this is data, wherein we've got now district level data, right, of credits and deposits. Just see both the credit share and deposit share, both have got their own tails. But if I were to look at the credit share, it's quite astonishing. Obviously, the top 8-10 cities, the metros, account for a bulk of our economic activity, right? And that is where most of the credit and most of our deposits reside. And in some sense, they are all intertwined, right? More credit you give, that also becomes a deposit in some other banking system. So in some sense, if you focus only on the credit side, you'll realize that, the top 10 metros account for lion's heart of all the lending that used to happen. That's changed quite dramatically. Look at what has happened in the last 15 years, right? So this is basically the number of districts, or the total number of districts. Firstly, the number of districts have gone up because they have become smaller over a period of time. But leaving aside that, the total percentage of districts accounting for 95% share of overall credits. So basically, there'll be always a long tail. There'll be 0.1, 0.2%, etc. So if I were to focus on 95%, I can do the same cut for 90% or whatever. Okay, you'll see these upward sloping lines in each of them. But it's just quite impressive that we've seen almost a 10 percentage point increase. So that means roughly about 50, 70, 100 districts have come in, which have got more and more credit friendly over the course of the last decade. It's quite astonishing, right? In an environment where credit really hasn't grown, you've actually done a good job in terms of getting the unit economics right, in terms of getting more granular in terms of lending, in terms of more geographic. The same data, I haven't put it out here because I had only 2 data points, was the gender share in terms of banking. Again, a staggering development in terms of the number of women borrowers and women lenders who are accessing the financial system. RBI has that data, but it's quite staggering. Of course, it's also a function of Jan Dhan and all of those which are more linked to women, I am told. Even a lot of the housing loans given more to women. So it could be skewed because of those developments, but regardless, access to credit going up meaningfully, both in terms of geographical dispersion as well as in terms of gender, is what is going to unleash, again, on the barometer of the productivity increase. It's hard to measure a lot of these things, but these have all got these multiplier effects that can propel for faster growth. The number of districts which are growing more than 10% plus, that number is close to about 90% now. So you're seeing a reasonably equal distribution across the board, right? Wherein credit is just not, Bombay and Delhi, etc. firing. It is happening across length and breadth of the country. Everything is. Of course, maybe 10% itself is a low threshold. As I'll show you in the next slide.
50% of our districts have only less than 5%.
Yeah, absolutely nothing. But we were even lower 10 years ago. I don't think we'll ever reach utopia. If that is what we are, at least not in our lifetime, we are going to see that. Ultimately, we have to see the slope and the rate of change. And that is happening in a quite a staggering fashion, in my opinion, in the last 10-15 years. So, it's so... Correct. So it's open to interpretation. The way I view it, it's a positive. But of course, it's always a glass half empty, glass half full. As you rightly pointed out, 50%. So,
can be, yes, we see that, the credit is rising across the districts, right? But then again, when it comes to, say, street, P10P, there are small scale or a medium scale. And again, we know that for the fact that it's a medium working thing. If we look at that statistic and share of FPAs and say metros versus, especially when it comes to retail or so on skill, share of FPAs and say metros and then a smallest.
Yes, absolutely. No, but I think it is also a function, in my opinion, that, these were basically the role of money lenders out there, right? So you're moving from a 20, 25 or a 30% kind of an interest rate moving into the formal banking system. And mind you, all of this is just the scheduled commercial banks, okay? I've not even brought in the NBFC in this entire picture, or the MFIs, which will make it a lot more democratic. Of course, for an MFI, this will just capture the lending happening out of Bombay. It is just one borrower out there, right? So this is just the banking system which has gone more and more deeper down, which to my mind, I think it's a staggering development. Of course, as we rightly discussed, everything is open to interpretation. Happy to listen on the other side. So yeah, coming to your point, 10% itself might be a low threshold. If you look at 20%, again, obviously we are starting to rise. We are talking about 20, 25%. So 1/4 of the country now is starting to see a 20% plus kind of a credit growth. Still too early in the cycle for us to get worried, in my opinion. But yeah, at the end of the day, there are pulls and pushes of the overall system and the animal spirits that need to come through. As we are going to see more and more animal spirits come unleashed, is where we're going to see this full blown come through. Right?
What is more surprising is why was saying.
Yeah, so which is where, right? In fact, one of I think part of my conclusion that people who keep thinking that we're going back to 2003 to 7, possibly there's a very, very different kind of a cycle in every dimension. Barring of course markets with the way they are moving. In every other dimension, I don't think that's the right barometer to think of. That was a time when everything was going right. The world was in the right area. We were doing right. Animal spirits rocking. We had a whole bunch of productivity enhancements prior to that, which helped us take off. Those really were the golden era of risk taking. So it's going to be a very different era. I don't think we should be ever thinking that we are going to go back in a reasonable hurry going back to that regime. Okay. Now I'm going to rush through. In terms of capex, I think on the public capex, there's a lot written in terms of what we are seeing, and we are seeing it right in front of our eyes, right? The amount of metros that are getting constructed, the roadways, railways, etc. The scale is of a different order. Yes, any compounding machine always appears like that. But even then, I think we have seen a meaningful increase in terms of spending on infrastructure. This has again been one of India's weakest points, that we don't spend as much on infra. I think we're starting to get that act right. But is it starting to move in terms of private sector is where I think, the baton has to move from the government to the private side and households is where we are starting to see small green shoots starting to emerge. This is, of course, capex of the top 1,000 companies. We still are just about starting to get through. I think this is the important point, right? Before COVID, how not to be an NPA was one of the most discussed things in boardrooms. Today, where are we going to invest our cash flows is what many boardrooms are talking about, right? And I think that is a sea change in attitude. People still aren't putting money where the mouth is. It's still a thought in many places, but it's slowly starting to mainstream is where our sense is. Okay.
Let's look at the previous slide. Yeah, maybe you commented on it. But, this speaking on corporate story, I'm going to project my revenues grow. So people are now projecting that the years both big would be amongst the highest in the world, at least for the next 2 years. While this curve is showing the capex to net sales declining, well, intuitively one feels that this ratio is not this particular ratio, right?
No, I completely agree with you. And so this is backward data. This is still 2022. So this is on the listed side, right? Listed side, total capex was about 6 lakh crores. 6 lakh crores. The whole of last decade was about 6 lakh crores. We moved to 7 lakh crores for the first time last year in FY23, right? As I'll show you in the next slides, the amount of cash flows that we are starting to throw for these same set of companies is about 11 to 12 lakh crores. This number used to be about 6 lakh crores pre-COVID. So whatever we were getting in terms of cash flows was getting spent on capex, and that capex was primarily maintenance capex. Right? There were obviously some groups which were growing aggressive, but on an aggregate, when we look at it, it was primarily maintenance capex. Now, with that curve moving wide up, as I'll show in the next few charts, you're starting to see that happening, that, people want to think about where to spend, which is why 6 lakh crores has moved to 7 lakh crores for the first time. Of course, sales has also gone up, right? Sales have also gone up because of commodities going up, inflation coming through, etc. These are nominal numbers, right? And so therefore, it kind of distorts to a certain extent. But I think, and this is stuff that I keep tracking also, in terms of, say, the number of companies or transcripts which talk about capex, you can actually see a beautiful pattern. It's across the board, everybody is talking about. Of course, there's going to be, again, a very different capex cycle. It's not going to be one steel plant or one power plant with 10,000, 15,000 crores. It's going to be small corporates, mid corporates, as well as large business houses putting 500 crores, 1,000 crores in multiple such projects. At least that is what we've seen so far. It's still very early in that cycle. And the success of these projects will determine, how mainstream it becomes. People are still putting maybe 10, 20, 30% of their cash flows into new projects, which they were not putting at all before. Now they are putting it. But for it to become a bigger thing, as I'll show you in the next few slides. See, on the listed side, not much. It's more on the unlisted side because a lot of the big bang PLI, be it in auto, electronics, in which case it's not so much a capex, but manufacturing, etc., is more in the unlisted. Hydrogen. These are all huge numbers, right? Do they have anything to do on the listed side? So I haven't put it here. It's not, see, one of the things that I have always sought to put out was at least having data for 20 years plus, which is what I said at the start. That data that I have is 10, 15 years, so which is why I haven't put it. But yeah, happy to share it. I have already posted those in Twitter, so if you can look it up, you will have that on Yeah, on the unlisted side also how it is. Okay. But to your point, are we starting to see that change happen? Like, this is still 23, okay? So this is basically capex as a percentage of OCF, right? So like I said, we are at, say, 70% of OCF today. Roughly about 11 lakh crores, we are spending about 7 lakh crores, roughly, in terms of capex that's starting to come through. This number at the peak goes up to 200%, which is when people get fully convinced that, India's decade is coming, this is happening, I'm going to put my heart, mouth, everything into it. It's an all-in trade. Right? We are still very far from that. Right? The last 10 years have been quite painful for most CFOs and CXOs for them to change overnight. But we are starting to see business houses change, which is what I have shown here. This is the large business houses, the top 10 business houses, as a percentage of their total capex, right? This number used to be about 14% in 2001. It's now close to about 37%. So almost a third or more than a third of total capex that's happening is happening out of these top 10 business houses. So we are starting to see the big business houses putting money, and this happened during 2015 to 2019-20 as well. It's not that now is when it's accelerating, but this trend is accelerating even more. Right? You're starting to see the big getting bigger.
But it seems like banks are now bidding funding the capex. The current credit cycle is mostly driven by R&D. And if you look at the corporate credit, it's only 4-5%. And if you look at the...
Correct. So I think the reason is what I just said, in my opinion, is that corporates are sitting on excess cash. You're throwing 11 lakh crores of OCF. You're spending 7 lakh crores. So first you want to utilize your internal accruals as much as you can to fund the next wave of growth, and then you want to take on debt, right? So you are still in that. So this is how cycles are, right? From neutral gear to first gear, we are in the first gear. As we move to the third and fourth gear, that is when you're going to see this 170, 120, 130, which means that you're taking on leverage, right? Currently, your internal accruals are more than enough in aggregate terms to do that. So why do you need so much of credit?
But it's about the unwillingness from the parts of the bank.
I don't think. Yeah, but I don't think so. It is so much unwillingness, is at least what we've been able to discern from our checks and banking system. I don't think that there is any. People want to get back into corporate lending. It's, of course, retail has got its own momentum going on for it, and maybe the problems of the next cycle will come from there rather than from corporates. Could be. But clearly that cycle is more than willing to let off.
So even if you see what HDFC and all, they're very massive distribution channel right now.
No, actually, they are, while we all know them, I'm not getting into stock specifics. So, but if you look at the color of their book, from what used to be a significantly retail-led dominance in the first decade, 2000 to 2008-10, which is where they came out reasonably much better off, they've actually gone the other extreme. When everybody else was shying off from retail, they've actually gone into corporates in a big way. In fact, that's something Mr. Puri used to constantly keep saying, I don't know why you consider me as a retail bank. Again, I'm just making this quote purely out of public records, nothing for or against a bank, etc. So this is again the same point, that the large are getting larger. Ultimately, capex done today is a source of future cash flows 2, 3, 4 years down the line, and clearly the larger companies are the ones taking those decisions today. So it's got implications even in terms of, say, investment returns from various categories of asset classes. Okay. Now, this is an interesting trend that we saw, wherein while the listed space didn't see too much of capex, we saw a huge flurry of investments in the unlisted space, right? And while investment is not equal to capex, I'm aware of that. But at the end of the day, it is some form of animal spirits that people are willing to show, right? And that's why I kind of lump them together, FDI together, and there are all kinds of FDI, so I'm aware of it, and capex done by the listed space, right? It had reached to a certain extent, and I had flashed it out, that on a monthly basis in September of 21, the amount of money dispersed by various VCs was close to about $5 billion on a monthly basis. This was more than all the listed companies put together on the private side that were spending in terms of real capex on a monthly basis. Such was the scale of distortion of capital, quote-unquote, misallocation that was starting to happen, right? Basically, India is all good, but there is a particular capacity and capability of that pipe to invest in. If you keep putting in a lot more, at the end of the day, you're going to get a bad experience, right? Now, this also has implications that a lot of FDI that came in the last 5 years is wanting to come out with an exit in the next 2, 3, 4 years. Exits have not been that large. While it's been good compared to many other countries, in the last 5, 7 years, the total primary market and IPO markets have been actually much lesser compared to what it was before. So are we going to see a reversal happening in the next 5, 7 years, wherein you're going to see a lot more exits happening out? Maybe, who knows? Or you can also have a case wherein you have all these corporates flush with capital who may actually just go and buy out a lot of these things without having to come into the program.
Yes, and this is a very interesting data put on the left side on the gap.
Yep. So people's...
Wait, last year, $62 billion was spent by truck. So I think that it's like an iceberg. What we are seeing on the surface, interesting, less than what feeling the service the Unlisted car. Yeah.
So it's a beautiful metaphor that you bring through iceberg. See, ultimately, I'm a big believer that capex is important, right? Because that is where the next source of cash flow streams can come through. You can only squeeze as much efficiency gains without spending. And I think, therefore, a lot of unlisted companies will create a great amount of wealth but then when you induce them with steroid-like kind of behavior, chances are that misallocation is likely to happen, which is what we have kind of seen some kind of semblance over that.
But a lot of this we see when you are getting over fund losses, it's ultimately we're with salaries or something about working capital and not building fixed assets.
Yes. Yes.
But private equity is not that. Private equity is established companies. If you look at Kotak, about $8 billion AUM in private, that no.
Right, correct. So, about a year and a half back, I had written this thing saying that, and I'm kind of digressing. The first, so there are basically you've got the producer surplus, then you add the agency surplus, and then you add the consumer surplus model. These are the three broad models, right? The producer surplus model is basically that, you manufacture, you create profit pools out of that, which was what the first 10 years of this millennium was primarily. You basically run plants and you spend and you get out of that. The last 10 years pre-COVID was primarily an agency, which is basically a trading. You were primarily betting on the distribution game, saying that can I trade in from China, and sell it and create my distribution platform in India? And that is where I'm able to capture more of it, right? And in the last 4-5 years, we went into the consumer surplus kind of a thing, what you rightly alluded to, wherein the idea was to create a habit forming. You give them a way so that once that habit gets formed, we'll find a way to monetize it later, right? Of course, I think that thing has got short-circuited given the funding winter now. But I think especially in a world where winner takes all is starting to become more and more the norm than the exception. I think, we keep talking and quote unquote maligning VCs. In fact, I think my next slide is going to talk about that. Maybe, yes, which is that I'm now very worried that we have got a problem of plenty as far as the listed companies are concerned. And when you have got a problem of plenty, they do terrible things. Bad times actually give some of the greatest investment returns. Good times actually give very poor returns. And we are starting to see signs of it happening in terms of, say, unrelated kind of investments, group companies getting more share, etc. As long as it goes into pure capex into their own manufacturing capacities, I think it's generally good capex. But if you start moving it into unrelated areas, so when we are talking about 4-5 lakh crores, and this 11-12 lakh crores will become, say, 15 lakh crores, 16-17 lakh crores in, say, the next 3-4 years, okay? And maybe your capex, and again, I'm just throwing numbers out of a hat, from 7 lakh crores can move to, say, 10-11 lakh crores. But you still are going to be sitting on reasonable amount of surplus. And while you've got certain sectors like, say, IT sector, which gives back in the form of dividends, most companies in India are loath to giving back to the shareholder, right? That leads to empire building, that leads to acquisitions, that leads to wrong capital decisions, which then can haunt us. So this is something, for now it is all okay, but I think we'll have to watch out for that, whether we are going to go through this cycle again in the form of unrelated kind of acquisitions. Okay. The next 3 slides very quickly. These are short-term slides. These are in the long term. I think the Indian consumption story is great. I spoke about our population, demographics, etc. But in the short term, we do see some kind of a softness in consumption. Again, it's a short-term trade. So ideally, it's not part of the mega trends, but since we are covering all of it, I just thought I'll share it with you. This is in terms of the 3-year CAGR of PFC. It's not been the best. Again, Indian data have shorter time series. Again, if I exclude GDP of the government, which has done a lot of heavy lifting, on the private side consumption, it's been a lot lower. Again, these are 3-year CAGRs. Okay. If I look at electricity consumption, it's actually been, while we continue to keep rising, as you would imagine in a country like ours, but the pace of growth has actually come off quite meaningfully. One thing that's puzzled me, and I really don't know the answer, I may be sitting in Delhi, you guys know it better, but our overall per capita consumption of electricity as it is very poor. We are one of the lowest in terms of per capita consumption. So I would have thought that in a rich state, our per capita consumption will keep growing faster and faster, because even that is significantly lower than the rest of the world. But if you look at what I've plotted here is some of our richer states, and of course UP and Bihar, which are the fast-growing states. These 10 account for most of our economic activity, as far as India is concerned. But if you look at states like, say, Delhi, or even Gujarat, right, you've got, say, 7 years which has grown lower than the all India per capita growth. Of course, I do understand that, the all India levels are coming from very low levels of Bihar, etc., which push it up. But as I had shown you, the earlier slide was the all India levels. That itself isn't in great shape if you were to think of the growth that's starting to come through. In that kind of an environment, to see, states like Delhi, which have had, say, anemic growth for like 7-8 years, befuddles as to why is it that we are not growing even at these levels, right? The southern states are slightly better, right? And of course, you've got the states of Rajasthan, AP, which has done quite well. But overall, it's a mixed picture as far as consumption is concerned. I think that, we are going through some kind of a softness, especially, we all hear about the K-shaped curve. I think the bottom of the pyramid is definitely a lot more challenged post-COVID. And it's coming through in multiple manifestations. And therefore, while continue to be very positive on the longer-term consumption trends, I think possibly it's a good opportunity, but we also need to introspect as to whether we can let this continue. Sure, possible. But then you would think that Gujarat, etc., would come through. See, all of these are valid narratives. I guess we'll never be able to break this over the other. But the point really is, and I'm just making a point. I have no idea of whether it's right or wrong. If you look at China per capita consumption, okay, and I don't know, I don't think I have plotted it here, but that's still growing, and they are like 5 times or 7 times our size on a per capita. They're growing faster than us, okay, and it could be a function of multiple things. We don't know what the underlying is, but the efficiency that we are talking about, I'm sure even they would be using it, right? It's not like first.
Confirm the authenticity of this data, because
I see this has come from CEA. So I would think that's reasonable. Electricity is measured, etc. Per capita, maybe you can say denominator, etc. But you also have the state-wise trends, and it's not very different. I of course chose the per capita. One can look at it from state level.
Even all India growth is like 2%, 3%, 4%. It's only after 90 that like trend is kind of accelerate. 2021 would be 90, 20, 21, 22. But it's always the last 3 years that this ESL movement has started replacing all.
No, ESL I think has been longer. Again, the extent of what they have done possibly has intensified in the last 3-5 years. But I think, I don't think even a 2, 3, 4% is good enough, quite honestly.
The nature of it, it's not like a...
Yes, systems, correct. Because, the gap between us and the rest of the world is so large, right? And for sure, and this is again something that we keep picking up from channel checks, etc. Many people say that, I'm selling more ACs to the people who already own an AC. I'm not selling more to the people who are the first time buyers. I don't know whether it's true, whether it was always the case, now it has increased, etc. It's all open to interpretation, but data is what data is, and authenticity, I think, is reasonable. In this case, I would say. No, not at all. EVs are, again, I don't have the numbers offhand, but even if, again, I'm just making this comment to sound extremely sensationalist. Even if I think the entire fleet of two-wheelers of whatever we are selling, the flow, were to move into EVs, it would still make like a 0.5% dent into the overall thing. So, and I don't think that's really it.
Yes, the kill population. So that 30% if I have to, not in that.
What the joint that like
Possible. So ideally, all of those should mean more growth, right? Faster growth. I mean, again, this is just anecdotal in the sense that if you are having, say, one geyser for 6 people, now you're going to have 2 geysers for 6 people in 2 houses, right? I mean, I don't know.
real electricity consumption comes from, say, factories, that's houses. So if you talk about AP, right? If we go deeper into it, AP is the space which has perhaps added
Industries, yeah. True. No, it's a valid point. Yeah. So actually, I have posted for the industrial use also. So I mean, it's an all India industrial use trend.
Yeah, only in India or it's a global? Because I think nowadays all the companies are especially concentrated on energy conservation. It's taking new steps. They are cancelling office of your careers.
Yeah.
Just for the sake of carbon footprint, decrease. So my company has completely stopped, incentivizing any official trade. If you have taken opportunity, we have used it. I say I kept similar amount of money in the carbon. Why?
So
Seeing that this is a global trend.
So it is a global trend in the sense that our energy efficiency is improving. So let's say the GDP per energy consumed, that is going up significantly faster than the energy consumption, right? So there is definitely energy efficiency improving. But at least, see, the way I look at it is that China's per capita or total energy consumption and ours, they are like, say, 5-7 times our size or maybe more. They're growing at similar or higher levels. I mean, maybe there is a case for us also to grow at that level, even with keeping into account all of these things. But all of these are valid. I mean, we'll never know the reality. These are all just observations. Nowhere else in the world are we anywhere close to this number. And it's an immense source of competitiveness that we have, right? Most of the other countries have grid power, etc. And we all know how grid prices have gone through the roof. In this kind of an environment, because of our inefficiencies of the past, the fact that, we never had grid power reliance meant that most industries, therefore, had put in captive regenerative power, etc. And therefore, almost 50% of the total consumption comes from captive. Okay, which is, I think, a staggering data point, as well as, in fact, I mean, we can speak on that. I mean, our competitiveness, I would think, has gone up quite meaningfully in multiple dimensions, be it on manufacturing, be it on services, which is what makes me reasonably positive on overall Indian industry as such. I think that compared to pre-COVID levels, the bottom of the pyramid consumption is definitely hurting. Consumer discretionary is slightly better off, but compared to the rest of the world, I think, especially in the developed world, the consumer discretionary is still better off compared to where we are because of the free checks that they have been given. Of course, with each passing month, that accumulated savings keeps dropping down. But where we are definitely in pole position, in my opinion, is both on infra as well as exports of goods and services. Our manufacturing and our overall competitiveness is on the rise. Of course, when we talk about exports, there is the looming recession or slowdown in the coming as far as the developed world is concerned. But I think this too shall pass. And if we look through that value of that, I think our share is likely to be much, much higher than where we are today, both in terms of manufacturing as well as in terms of services. So this is broadly a synopsis of where we think. Okay, this is my last section. And this is purely crystal ball gazing in terms of the possibilities which I had. Okay, so this is what the expectations today are. Basically, what this plots is from, say, whatever $500 billion to, say, $5 or $6 trillion. How long did various countries take to go up from 1 trillion to 2 trillion to 3 to 4, etc. And there are basically only 4 countries which are likely to break or which have broken out to that 5 trillion plus or a 6 trillion plus, right? China, Japan, US, and likely to be India. This is the expectations that are running as far as how India is likely to cross through that Rubicon of, say, $6 trillion. Okay. Now, if you look at the slope because that is, in essence, the steepness or the pace at which growth is happening, right? What China has done is absolutely incredible. I mean, they went from $500 billion to say $5-6 trillion in 15 years flat. Every year when you start looking at it, 2008 they were like say 3 trillion or 4 trillion, 2009 5 trillion, 2010 6 trillion. Every year they were like adding $1 trillion or $2 trillion. Like it was, they were basically making, the whole other world is struggling to get there. They were doing it in a jiffy. And what they have done, nobody else has ever done, and nobody is likely to have accomplished what they have done in that steep of the gradient. Japan did the same thing, similar, though slightly longer in the 60s to the 80s, wherein they got that Japanese miracle done. Of course, in the last 3-4 decades, they've kind of stagnated at that $5 to $6 trillion, sometimes going up, sometimes going down. That's where it is. US took about 30 years to move from the 60s during Kennedy's time all the way to the Gulf War to make that entire journey. Of course, they are now much larger, but this is that journey from, say, $1 trillion to a $6 trillion kind of a thing, right? And India is expected to do faster than what US did in that entire journey, right? Of course, it doesn't mean that 6 trillion is a ceiling. There's a lot more trillions that we are going to do and add, given surely our overall economic size and scale. Okay. If you look at the interplay of the big two, which is China and US, and this is purely nominal terms, there's no purchasing power, none of that thing, which, I think is all in some sense flawed. But if you look at, say, the US share, from 60s, they were 40% of the world economy. They've come down to about 24% of the world economy. China, at the start of this millennium, was at 3.3%. And they sprinted close to about 18.5%, right? This is as of 2021. Of course, the last 2 years haven't been that great for China, including this year. And therefore, possibly, their share is starting to come down a bit, okay? Now, 3.3 is important. Just keep a mental note of that, 3.3, because that is where we are today, okay? India is at 3.3% of the world economy. What China was in 2000 is where we are now, okay? What I plotted here is basically, this green line is India's share of the nominal GDP, world GDP, right? We were at 3% in the 60s. We've just come a full circle all the way back to where we were in the course of the last 60 odd years, right? Of course, from 3%, we went down to about 1% of the world GDP, right? In the 90s, and then the reforms happened, the liberalization happened. And from there, we seem to have done a lot of things. Our generation has experienced it all, but actually we've just gone back to where things were in the 60s, right? And therefore, this journey, in my opinion, is just about starting up. We've just covered lost ground over the last 60 years. The blue bars are, of course, the rank of the economy in terms of the world. Today, we are the 5th largest economy, and quite likely over the course of the next 4, 5, 7 years, we are going to be the 3rd largest economy, surely by way of the momentum that we are bringing in. More importantly, the lack of momentum or otherwise that the rest of the world is experiencing, a combination of both of them, right? But this is the more important thing, right? A lot of people have these doubts whether we can be a 6, 7, 8, $10 trillion economy. I've chronicled the 7 large states of India, okay? And if you look at these 7 large states, their GDP size is roughly in the range of, say, anywhere between, say, 15 to 25 lakh crores, okay? Just a case in point, in India's GDP in 2000 was 20 lakh crores, okay? So each of these states, today's GDP is similar to what India's GDP was in 2000, okay? If India could go from 20 lakh crores to 250, 275 lakh crores over the course of the last 20, 25 years, is it conceivable that each of these states can be as large as what India is 20, 30 years down the line? There's been a lot of hard work that we've done to get to where we are. We need to do a lot more hard work, of course, but the template is known for each of these states if they want to themselves be $1 trillion plus, or maybe a 2 or even a $3 trillion in times to come over the course of the next 20, 30 years. So it is not totally impossible or not totally out of the realm of possibility to visualize that each of these states can be as large as where the collective of India is today. That really is where I think, if people take those bets early on, can see reasonably large outcomes. Of course, while we speak on aggregate, what matters for all of us is also the per capita, right? And that is clearly not very flattering for us. This is what China has done, right? It's quite insane that they were like 15% of the world GDP in 1990 in terms of the per capita income. So per capita Chinese income was 15% of the world average. In 30 years, in one generation, they have basically brought their entire population to the world average in terms of per capita income. Okay. Clearly something that's not going to happen in India, not because I don't think it should happen. I wish it happens. But what they have achieved is something which I don't think any of us can possibly hope to do for. But are we likely to go up? My sense is yes. We're again starting to pull back. Again, we were a small fraction. We're starting to get our act back. But we are still lower actually, while the aggregate GDP size as a share of the world, we have gone back. But in terms of, say, per capita income, actually we are lower than what we were or what our forefathers were in the 60s. On a relative scale compared to the rest of the world, right? We have a lot of ground to cover, but it is possible, right? It's likely to happen in the course of the next 20, 30, 40 years. Of course, exact timelines, etc. is all meaningless in my point of view. But is there a good chance it's going to happen? I do suspect that there's a very good chance it's going to happen. Of course, economy and markets are two completely different things. What I have shown here is basically the journey of as they cross through those various $1 trillion. We are currently at $3 trillion to $6 trillion in US. It gave anywhere between an 8 to 14% dollar return during that time frame, right? Japan, the same 3 trillion to 6 trillion, it gave a negative return. So I don't think just economic growth is going to translate into stock market or vice versa, right? Each of them have their own idiosyncrasies. Ultimately, people have to do the basics right, which is invest well, capital allocate well, and then you're going to get the fruits of that as long as the competitiveness is going to remain strong. It's important also to remember that in the case of India, we have actually a very small government. This is both the center and the state put together. We have actually a very small government. Therefore, government's job is more that of catalyzing entrepreneurship. It is going to be more private sector led, private sector dominated. This is what I was saying to the gentleman in terms of, say, 2003 to 7. The number of listed companies that earned, more than 10% ROE was an astonishing 60-70% of companies. It lifted all the boats that tide, right? Currently, we are less than about 0.5% of those companies earning at least a 10% ROE. And 10% ROE is also not a very high threshold, as we will all agree. To a certain extent, yes, but even I've published this from the lens of DuPont. Most of it is because of A, revenue growth being slower, B, margins have improved, but asset turns have also been lackluster. And yes, of course, it's also got boosted in the earlier cycle by leverage. Here, it's not there. But a bigger reason is more the top line growth not coming through and asset turns not improving as much as what it was in the early. Similar. It'll be slightly more upward tilted, but yes. These are, of course, the more sort of metric, ROE of 20%, PAT CAGR of 15%, and 15 and 10%. But you can see a slide happening with time, right? So this is, again, while it's too short term, 10, 15 years don't make a trend. Maybe it's due for a big mean reversion. But I would still think that, it's going to be a lot more scarcer in terms of finding good companies, and which means that valuation creep is getting more and more. The ones that are delivering are going to get even more pricier, as we've seen in the last 5-7 years. Okay. So, in conclusion, India has a lot going for it. I think if there is one takeaway I want from this presentation is to be optimistic on the prospects of India. I think demographically, the productivity levers that we've kind of invested in, the cleanup of our entire banking system, the leverage levels, the fact that we haven't gone on to the steroid of debt to get to whatever growth, all of them are, I would say, a great thing that, the best is yet to come from overall economic activity. There's another data point that I saw based on GST filings, right? The number of companies that have reported based on GST filings with more than 500 crores of revenue have gone up by 50% from 2019 to 2023, right? From about 7,500 odd companies to about 11,500 odd companies. It's a staggering rise. You're seeing that informal to formal, unorganized to organized, as well as the entrepreneurship starting to take shape in the form of animal spirits, etc., starting to come through. Of course, there is a K-shaped recovery. You are seeing the benefits of the productivity enhancement going more to those who have the resources than to those who don't have. And that's got its own equations from a social perspective. It's important to identify companies that allocate well. Like I said, the curse of plenty of capital is that we may get suboptimal returns. We have to be very careful to monitor companies that are splurging their cash flows into all and sundry. I think the last 10 years were characterized by an era of frugality. In a plentiful era, it remains to be seen whether companies and investors make prudent allocation decisions. Lastly, even though I spoke about mega trends that lasting many decades, etc., the reality is that they also go through cycles. So it's important that, one is diversified. Don't bet your house on these trends. Asset allocate well. That's about it. The movie is over. Thank you. See, I don't think there is anything from various rating agencies or CIBIL or all those bureaus which give any sense of that happening. But I think in the lending system, especially when the bottom of the pyramid isn't doing that well, there is a possibility that there might be surprises. Okay, and so it's merely a hypothesis. I don't think it's got any. It's not. There is no evidence of it yet. But I would think that when everybody is growing, I mean, there are banks which are saying they want to double their personal loan book every year. And these are not small banks, right? We are talking about 2 lakh crores, going to 4 lakh crores, going to 8 lakh crores. It's not a great sign, if you ask me, of that. But it's more I would say, conjecture than anything else. I have nothing to suggest that that's happening on the ground.
We see that the political scenario that we have a market capitalization of 55% of what they asked a bit, we US is left one ideas of what they were. So you draw that compared to the of that and the perspective.
So, I'm just going to lay down 3-4 observations without getting into the fact that on valuation, because how much of it is priced in is anybody's guess. That's the reality, okay? The reality is every year there is a drawdown of 50% in Chinese market, okay, or 30 to 50%. So it is more the norm than the exception. So therefore, you need to know exactly when the president is going to wake up and say enough is enough, and then you make crazy returns, but then you are going to also see the reversal happening at some point or the other, right? So can you give in disproportionate capital to such an asset class? I don't know. Secondly, in their scheme of things, again, someone alluded to this, that they are more careful of their currency and the bond markets than on their equity markets now. Good, bad, ugly, whatever it is, that is their priority. Whereas in markets like India, in markets like in US, I would say that equities has got a lot of, especially in US, the wealth effect of equities has a lot of signaling effect that comes through. So while you see a huge amount of Chinese investments, the local residents going into equity markets, I would think that at some point, it will also be the importance of the policymakers to say that, well, they don't experience these negative shocks, right? But as much as money has gone to equity markets, more than that money has gone into real estate. And wherein they have seen a linear kind of a rise, which clearly is likely to implode in some fashion, right? Because there's a massive disconnect. So their bigger problem is how to manage that than how to manage the equity markets, right? So therefore, again, doesn't give a lot of confidence that you have got the policymakers put in some form or the other to say that, okay, at some point it is going to be bailed out. Third, of course, is well known that, at the end of the day, when you can get nationalized is anybody's case. So do you really have access to those shareholder, as a shareholder, to the cash flows? Or is it, just a lien which can be called in by the government at any point of time? So how do you therefore assign a terminal value to such a thing? You can say that near-term cash flows are very great. So you can be a REIT investor or those kind of instruments. But then do you really have access to the terminal value of that asset class that's being created? It's open to interpretation. There are, of course, some famous investors who kind of thought that it's all in the price. Like I said, I don't know how to price that. Right? The fact that terminal value can be zero for such an asset class. So now, whether they are going through an implosion, I think the bigger challenge is on the demographic side more than anything else. The fact that they're not able to have a rising population, I think, creates problems to them than otherwise. But the demise of this Chinese policy has been in the works for you will have these newspaper headlines coming every year from 2008-9 onwards, saying that they've taken too much leverage, a lot of things is going to fall out, etc. And they have constantly kept on trying to push the can down the road. So, is it going to implode today? Who knows? But the good thing is that not too much of foreign capital is in that space. Right? It's all domestic savings. So which can be subsidized in one form or the other. And they've got such a huge savings rate. So they are not really dependent on foreign capital for anything, which means that they can sustain themselves for much longer. So it's a long answer. At the end of the day, my job was to confuse you, because even I don't know what the true extent of it. But I would think it's a good optionality instrument at best, is the way I would look at it.
You never really own a stock in China. You maybe look after it for...
Well, yes. True.
Just think about that.
So the reality is that, we've always been a capital-starved country, right? And partially it's also a function that private enterprise or households used to do most of their savings in physical assets which have a low multiplier, be that of gold or be that of real estate, right? Which is further compounded that problem. So even though households may be saving a lot, they are in areas which have a lower multiplier compared to financial assets. And of course, we are making that journey from physical to financial, and that will also go through its cycle. It's not going to be a one-way, right? But the reality is that as a country, our savings rate and our investment rate, there is a gap. And so we are constantly going to require financing from the external world, either through remittances or through our own exports coming through, or in the form of investments through either FII or FDI. I don't think, we can be in a zone where we can say we are truly Atmanirbhar, etc., wherein we can finance our own investment growth. That's that. So there is that gap, right? Some of that can come through when interest rates come off quite meaningfully, right? And some of it will happen when that, today, if you look at it, it's still the flow of savings that is moving into financial assets. The stock of savings is still disproportionately in physical assets. That also has to start changing. It's all over generations, right? These habits have come through over 2, 3, 4 generations. Not going to change overnight.
Most of some people are having plans, and the first question that comes around, the gold policy, which should be real estate for.
Correct. So it will take time. So I don't think there's a solution for it. We have to be friendly to investors to keep coming.
When we talk about per capita income, then per capita spending, right, or basic necessity, how much do actually and again, I feel the K-shaped recovery that we are talking about, it would take this further, because
at the same time, when the people end up spending more in terms of necessity, the needs, the safety is definitely very sort of what to say.
Yeah, so we've seen an increase. I think partially is also the retail loans going up. So there is a greater amount of leveraging happening on the consumption side for various consumption categories, right? So again, it's that good because ultimately that savings could be channelized for investment, which can be a greater tomorrow instead of being consumed today. Right. So I guess these trade-offs, there is never a right answer to it. But yes, the haves and have-nots, the gap is going to widen unless that is checked. And that's got meaningful implications on the longevity of the cycle. We are talking of the next 20, 30 years. It needs to be.
About say health, like the majority of families in India are just one health trend. Yes, on the economy.
True. No, I think these are all valid. I think again, these are small mini trends. I think the portion of out of pocket spending is coming down in India, if you believe the data that is. Over the course of the last 15 years, we've started to see that happening, that the public spending is actually going up faster than the private spending. Again, it's hard to really visualize all of them, but especially when I look at our own healthcare spending, but that's the reality. So I think that the bottom 50% is sustenance living, right? So, whatever be the definition, it's not going to meaningfully change. So can we see that happening? Maybe in the next 20, 30 years, possible. But at least in the next 5, 10 years, I think it's a tall order to envisage any kind of movement of the aggregate per capita income of the bottom 50%. Obviously aggregates, we all push up the aggregates quite meaningfully, right? But is there a solution for the bottom 50%? I think there is no easy solution. We don't have the money to hand out to them. Productivity is good, but it takes its own cycle. There's a cycle for it. Yes, we're doing the right things in terms of saying access to credit, etc., which is great, but it still takes time, right? It's not that each MFI has a cycle, gets repaid. You can't short circuit that entirely, saying that you can do it. And in an environment where the world is slowing down, there aren't any easy solutions the way I see it. I don't want to be despondent or cynical, but I think I think it's a longer term objective, not something that I see improving the next 5 years.
It's then that was suddenly that negate. Really late 6 million something it's reported the white rate bill they don't got in your release state that top level against the road bills to make it was like.
No, so firstly, 1% doesn't control anywhere close to 90%, but I get what you're saying. See, ultimately, like I showed you, we are improving on the per capita level. It's just that the pace of improvement, there's a lot to be decided. And that is true for everything in India, right? So are we in the right direction? Absolutely, yes. Can the pace be faster? Without a doubt. So I think those, to my mind, I think those 5, 6, 7 trillion mean a lot. Because that is when our relevance to the world is improving. So I would say that a lot of things we've been dealt with the wrong cards also because we never had a say in a lot of things. Now we are getting maybe our rightful share about it. So I wouldn't say that, not having a view on that is bad. It is very important to be a large country with economic might to be taken seriously. This is a tougher road to climb. We are climbing it, but you can't change that overnight. We'll get here faster than that.
What's the gap like in China as we speak, the income disparity gap?
So people, obviously the Gini coefficient, etc., that measures it is quite wide, but it's not as bad as, say, Latin America or even India or Russia. It's closer as well. But see, beyond a point, I don't know whether all of these are worth tracking or...
No, I saw one of the graphs that shared the per capita increase in China being exponential.
Yeah.
That must have lowered the...
No. Because if I look at per capita income and per capita debt accumulation, debt accumulation has been stratospheric. Right. So ultimately, and debt is again a transfer of from the wealthy to the poor. Right. In some sense, you are taking more of their income and going back to those who don't need. That's how consumption is happening. Right. It is always from the owners of capital to the consumers of capital. Right. So I had done some work on it. And it was a staggering amount of data. Right. Almost 1/3 of the per capita income goes as mortgage payments in China on an aggregate. That's I mean, in US the number is 10%. Right. Yeah. So that is obviously the greed factor out there which fueled it, and so which is why I was saying, right. What matters is how the real estate issue is solved. And quite honestly, we everything that we have is also worse than a blind man looking at an elephant. Nobody really knows what the scale of the problem there is. But I would say that real estate orderly kind of thing is what is more important for China than anything else. I mean, stock markets, etc., is a small distraction in their scheme of things.
Right.
No, so I mean, that is, in which case I am not a financial advisor, so I have got some, I mean, firstly, all my money is only in India. But I do think Japan is an interesting case. I mean, this is something that I've kind of said in public forums last year onwards. I think the fact that their currencies have depreciated quite meaningfully in an export-oriented setup, I think, after a long hiatus, I think there is possibilities out there. I would still say the US-led innovation is a great place to be in. That's a huge secular mega trend, if there is one. Last year, it did give a huge opportunity, in my opinion, to bite into it. In terms of challenges, so I think it's more social than anything else. So the inequality, it's hard to measure how it manifests, right? Are we providing as many jobs as we would like? The answer is no. So at some level, you cannot have this disparity continuing, and people, saying that, the people who have the resources, the haves, continue to keep prospering and growing at a faster shape than the have-nots. I think that has got the biggest thing. I think we are getting into a situation where pension bills again are going to cause some worry. So again, some data points, again, I may be a bit off, but if I'm not wrong, the amount of money that the government is spending on pension is roughly similar to the amount that they're spending on education as an aggregate, right? And pension benefits maybe 1% of the population. Education possibly benefits 25-30% of the population, right? And so, I mean, and both are valid points. I'm not saying that, one shouldn't pay the pensioners, don't get me wrong. But then, especially going back into these old regimes, etc., I think, can that genie be uncorked and lead to even bigger troubles? I would be watchful of that. The rest, I think, the good thing about India is that in the last 30 years, regardless of whatever government policy making, it's been pretty much consistent that, private sector has to do the heavy lifting. Government can only be a catalyst. And I think those continue to remain. So I don't think too much of that, but I would be very mindful of the social areas, which quite honestly, I have low grasp of. Dollar. No. I mean, de-dollarization to what? Right. I think if anybody gives that answer, then we can have a topic to discuss about. I mean, we all know the flaws of that, but everything else has got a bigger flaw than that, right? So, I mean, yes, over a period of time, can we see 1%, 2% going somewhere else? Yes. But are we going to see, 2/3 of the world reserves, etc., or the trading currencies moving out? Maybe in 15, 20, 25 years, at some point it will happen, but I don't think, I would want to really think on those lines today.
Do you think what change in political guard can relax to be for the momentum involved country in Congress?
Loaded question. See, I think there is definitely a lot of reforms that has happened in the last 8 to 9 years. I think, and crisis generally brings out our best reforms. This time, I think even in the matter of strength, we have implemented reforms. I think credit needs to go in for that, because otherwise we've generally done these difficult things only when we were completely pushed to the wall, right? So I think, therefore, there is a greater acceptance of the fact that, the tougher things they are able to do. Of course, there are a lot of other things that, one can say they haven't done despite having majority, but it's a never-ending thing. I don't think we'll ever get to what we all want, etc. Right? But again, when you look at the last 30 years of data from 1991, on any meaningful statistic, be it that of taxation policies, across the last 30 years, our regimes have been reasonably, you can say, consistent. It's a good thing that, our governments are small. Like I showed you, it's only about 20-25% of the overall economy. So therefore, their ability to misallocate is also lesser. They're constantly in their ability to try and find places of where to take resources. So yes, there is a sentiment definitely that can get dented. I think a lot of FDI has come in because of these reforms. That can definitely be on a wait and watch. We may lose out 2, 3, 4 years on that. In the bigger sense of the 30-year cycle, is that a lot? I don't think so. But, it's not that, we would want to lose this opportunity, because with every 1, 2, 3 years that we miss out, the chance of compounding, the chance of, breaking that gap that we have in per capita, it keeps getting wider. And at some point, today we have got the demographic advantage. With every passing year, it will soon become a curse, right? So, but, does the world come to an end because some political verdict changes? I don't think so. But do we want stability? I would think so.
And so what are the sort of top breakdowns according to the pendings on data filters?
I think a lot of reforms need to be on the state side, more than the center. I think it might surprise you that of our total taxes that we pay, direct and on the consumption taxes, I would say, disproportionate amount goes to the state. While we keep focusing on the center for everything, actually it's the state that, aggregate state spends are much more than the center spend in infrastructure, in public administration, even in terms of taxes, they take a lion's share. So I think we need to be a lot more focusing on what the states are doing. Okay, and I'm not saying they're doing bad, don't get me wrong, but I think there are a lot of reforms that they need to get. So just like we did a lot of heavy lifting, including on the electricity side, on the concurrent list, on the education side, health side, all of these are on the state or the concurrent list, and that is where I think we need to push a lot more than not necessarily the center. There also obviously there are, but I think they've done a lot of heavy lifting.
We talk a lot about demographic dividend. Well,
if this AI
actually becomes a reality, it is going to hurt birth limits. Have you seen it?
So, I don't have a very clear view, but I see, again, maybe I'm trivializing it, so please pardon my ignorance in that case. It's like when SAP got introduced in 2000, everybody said, this is the ultimate. In fact, forget SAP. Yesterday I saw an advertisement by Honeywell on email, okay, saying how it'll revolutionize, and this was in the 80s or something, how offices will become super smart and efficiencies will go through the roof, etc. Right? The reality is all of these definitely do improve productivity. But if everybody is spending on the same, then it's back to square one. All retailers who have spent on technology and, this algorithm which helps in analytics, which will say that, your Coke should be kept next to your Pepsi at this height, etc., will improve 2% your sale. The reality is that all of these are good pitches by consultants and systems integrators to get their way. the reality is if all the retailers are going to spend similar thing, okay, they are all going to be in the same boat, right? And so when I think of AI, etc., I also think the same way, right? Can it democratize a lot of decision making? Yes. Can there be greater disintermediation? Yes. But at the end of the day, if everybody is going to do that, then it's all back to square one, right? It's only if there are some, and of course there are going to be early adopters, there is going to be some differences. I'm not saying that it is not going to be. And there is going to be greater efficiencies, especially in an aging society in the rest of the world as well as in India. We are going to need lesser human beings for doing a lot of our work. But at the end of the day, there is a need for differentiation. There is a need for some companies to focus on their core and to outsource a lot. I think that's a far bigger trend, and that I would think can sustain. I think the bigger challenge for India could be that, you've got almost 1 million people who need to be skilled in AI. The sheer intensity of additions that I've kept adding in the IT sector may not necessarily happen. And that has got second and third order effects, because IT as a space has meant a lot of business and opportunities and economic growth for the surrounding ancillary businesses, right? Can that see a shift? Possible. So yes, I don't think it's a complete game changer, but yes, do we have to tweak? Yes.
It's a eye opener for especially for the IT side of people. That should of the threat of the IT side. So it's all the manuals they get people staying on developing a manual capability or manual stuff. They need to.
Yeah, but like somebody said, the reality is that the large banks in US still have a mainframe computer. So I think enterprise decisions are a lot more complicated in terms of statism and CYA and wanting to see no negative things happening in your watch. All right, so it'll be a lot more guarded. Of course, that means that it's also room for disruptors who have a complete, a new way of business, and who will completely disrupt these businesses without a doubt. But is that entire business going to shut shop because of that, because of AI? I don't think so. I mean, it's going to be a 20, 30, 40-year journey to see that.
Nice. So do you think because of AI, the blue collar jobs will be more valued and the labor was very think that
Sorry, I'm not able to make that connect. Why would blue collar jobs?
is there to be more AI into the corporate and it seems to be certain start of this and
Oh, but safe. Oh, but you've got robots and autonomous driving and all of that happening at that end, right? And you've got automatic flippers of burgers already. You've got waiters, which are entirely machines that come through. So I think, at a particular price, people will say that it's worthwhile investing in innovation. If the price is low, like in India, then that still takes some time away, right? So I'm not so sure whether blue-collar wages will see a rise up. I mean, at least I'm not able to make that connect. But in regulated markets wherein they don't allow, say, migration and all that, and if you're saying that, everybody's standard of living has to go up, then yes, what was a $8 became a $16 per hour. All of that is happening courtesy these artificial MMTs and those fiscal transfers that happen.
In the world, China, the ability was tracking seriously. So you showed all these improvements and that the state that's linear or polyester. You see, these be sampling.
It's like कि हमने गोल्ड क्यों खरीदा है, हमें थोड़े पता है गोल्ड का क्या भाव होना चाहिए. It's just that a generation or 2 or 3 generations back, when there were wars and all, some people, or when the partition happened, people realized that the only valuable thing that proved to them was gold, right? And that just got passed on to generation over generation, right? In China, real estate you couldn't own till I think the 90s or the 95s or 98. And then the government started opening it up, right? And then you saw from extremely low levels, you've seen a one-way move up in terms of prices. And everybody thinks that it's the government's interest to continue, because the government also gets its revenues by the sale of that land, right? And therefore, it's a win-win for everyone that the government also gets a greater share of land proceeds. The buyer also thinks that it's going to go higher. And so the greater fool theory, right? Somebody else will buy ahead of me at a higher price now. It's hard to, when the wisdom of the crowd becomes the mania of the crowd, it's hard to decipher, right? But that's what it is.
Very wide cycle will be coming back if for supply will go offline more than the demand is destroyed. There's a lot of talk about true demand destruction to all the PV and all, and there not much capex happening. So
I think it's been reasonably wild swings the last 10 years. At this 10 years, I would think it's going to be similar. I'm not a big believer of the fact that there has been underinvestment or all of those. I mean, yes, see, the reality is that more and more money has been spent on R&D and on tangible or on intangibles, etc. And lesser money, especially in US, has been spent on energy. That's a known fact. But maybe we just don't need so much of energy in the first place. We are getting far more efficient, right? And they also know that it's next 15, 20 years before it moves entirely into electric or hydrogen or some other thing, right? So if you were trying to maximize the next 20 years, you wouldn't want to invest. So there is going to be this greater cycles that are going to come through. Yes, you're right. Possible. It's possible.
be the fruits of the
So I think our, again, there's some work that I had done some time back. Our total energy bill is 7 lakh crores that as consumers, industries, everything put together pay for electricity, and about 11 lakh crores is what is being spent on petroleum products. Okay, so about 17 lakh crores. This was pre-COVID. In today's rate, it would have moved to say 22 lakh crores because there's been a spike, right? But if I were to look at how that 7 lakh crores was, say, 7, 8 or 10 years back, that used to be like, say, 3, 4 lakh crores. So we are moving up that gradient for the electrification or greater spend on electricity than on petroleum products, right? And so which is why the taxation is so high on petroleum that people are making that shift to electric in various ways and forms. So at some point, I would say our bigger problem is going to be electricity, especially the discoms, in terms of how much losses can they absorb, etc., right? Than necessarily on petroleum. Because I think petroleum, I guess the growth is a lot lesser as more and more is moving into electric. So without getting into the valuation aspect, because that's got its own cycle. I mean, okay, I'm just going to give some data points, good, bad, ugly, you decide. 3 lakh crores is the total banking sector profits today. Okay, 3 lakh crores is roughly 10% of the government budget. Okay, 3 lakh crores is a huge amount of profit pool in a quote-unquote socialist India. In a capitalistic India, it's nothing. Okay, it's 1% of GDP. Should the banks be made more? Possible, yes. So 200 lakh crores of assets gives 3 lakh crores of profits. Is it conceivable that the next 3 lakh crores of profits need to come in at, say, 300 or 400 lakh crores of asset accretion than what it is? Because you need to get greater balance sheet heft for the same amount of profits, is my sense. At least most sectors in India are gravitating towards that. So the unit economics of the banking sector is going to go more into volumes, more into technology, more into productivity enhancement to get the same profit pool, right? Or the increased delta in profit pool. Now you'll have to assess whether you think that PSUs or private sector is more geared towards those elements, right? And if you make that assessment, I guess you will get your own answer. Because what has happened is already there. It's already known in the price, right? The entire NPA recovery, etc. is there. What is going to happen is the next 5-7 years, how they're going to move in these. And I'm not saying that all PSUs are bad. There are some very good PSUs also. But on these three vectors, in a regulated business, one will have to really think through. And then I guess you should be able to come to your own conclusion.
Benchmark that if you look at first, say, the 2 years back, I've got the same asset side. So profitability was that, right? So that an increase, whereas in the last year, with the benchmark, like you look at, like any say profitability.
Yeah. So which is the ROA, right? An ROA also in a business like banks can be is hugely cyclical and can get reflated for various reasons, right? So I think as a structural perspective, again, please view my things in the context of what I'm saying. In any cyclical sector, when the worst performing or the most inefficient person makes a lot of money, that's the time to be wary of that sector. Okay. So, no, metals is a classic case. I'm not saying that of banks.
When it comes to banking sector problems, right? I mean, it basically follows a particular pattern where the connecting rates are increased, then the banks will definitely go back to black, and then then the deposit, higher deposit rate starts to pace their balance sheet as well as the reports, right? So it's like
it's a cyclical business. You're right. Yeah. So which is why I'm saying, so in a cyclical business, you shouldn't bet on when the most inefficient person starts making a lot of money. Now, what is a lot of money is all debatable. Maybe next year, maybe a lot more. So that only with hindsight you'll know. But generally, in cyclical industries, you're better off when everything is bad. You can make insane amount of money then. When everything is good, I would say not the most optimal time to bet. Okay, I really have to wind up. I've got actually on the meeting. The last one.
They can take you to a lunch.
Yeah.
So lovely. Thank you so much, Harish.
Thank you
For the wonderful 2.5 hours spent. On behalf of the audience and the daily chapter,
Thank you.
Appreciation.
Thank you so much. Thank you. Have to send it back.